Welcome everyone to today's explainer. We're going to break down the highly anticipated provisions for the advanced payment of tax under Chapter 19-C of the completely revamped Income Tax Act 2025. Whether you're a chartered accountant, a CA student, a tax professional, or a business owner, getting a solid grip on these provisions is absolutely essential for smooth compliance. So let's start with a really practical question. As a business owner or a professional, do you just wait and pay all your taxes after the financial year finally closes? Or does the government expect its share as you earn it? Well, the fundamental obligation to discharge your income tax through advance tax is still very much alive under the new act. Let's look at exactly how this works now. Okay, here's our structured breakdown for today. 1. The advance tax mandate. 2. Computing your tax liability. 3. Installments and due dates. 4. A practical case study. 5. Compliance and transition. And 6. Summary and takeaways. Section 1. The advance tax mandate. Applicability and scope. Let's dive right in and look at who is legally required to pay advance tax under these new statutes. Section 403 sets a pretty clear rule. You literally pay as you earn on your current income. Now, this rule kicks in if your tax liability hits the 10,000 rupee threshold under Section 404. Thankfully, that threshold is completely unchanged from the old act. But there is a really nice exception here. Resident senior citizens, folks aged 60 or above, are exempt from this whole process, as long as they don't have any income falling under the profits and gains of business or profession head. Section 2. Computing your tax liability, the new formula. Under the old 1961 Act, calculating advance tax meant wading through some pretty dense paragraphs. But that's all changed. This right here is where the 2025 Act really shines. It simplifies the computation into a crystal clear statutory formula. Section 405 elegantly defines your liability as simply A equals B minus C. Your total advance tax payable, that's A, is just your gross tax on current income, which is B, minus any TDS or TCS that's already been deducted, which is C. It's the exact same policy logic as before, just presented in a much more logical, reader-friendly format. And this brings us to one of the biggest conceptual shifts in the entire new act. We are finally saying goodbye to the confusing dual terminology of previous year and assessment year. The whole thing is replaced by a unified tax year that aligns perfectly with the financial year. So income earned from April 1st, 2026 onwards will simply be assessed in tax year 2026-27. There's no overlapping, no missing years, just a straightforward way to talk about your tax periods. Section 3. Installments and due dates. Mapping the timeline. All right, now that we understand the liability and the new tax year, when is the money actually due? Section 408 lays out a strict 4-installment schedule for regular taxpayers. You'll start by paying 15% of your estimated advance tax by June 15th, then step up to 45% by September 15th, 75% by December 15th, and you've got to hit the full 100% by March 15th. Any amount paid on or before March 31st is also safely treated as advance tax for that financial year. Basically, this just ensures a steady flow of tax into the government's coffers all year long. But wait, there is a massive exception to that schedule. If you are a small business owner or a professional who opts for the presumptive taxation scheme under the new Section 58, which completely replaces the old Sections 44AD, 44ADA, and 44AE, the law gives you a huge break on compliance. You are legally allowed to pay your entire advance tax in one single installment on or before March 15th. No quarterly tracking required. Section 4. Practical case study applying the provisions. Let's put some real numbers to this so you can see exactly how it works for a taxpayer. Imagine a professional estimating their income for the new tax year. Their total tax on that income, that's variable B, comes out to 1 lakh rupees. Now, they expect clients to deduct $40,000 in TDS, giving us variable C. So plugging that into our A equals B minus C formula, their net advance tax liability is 60,000 rupees. Since they aren't using presumptive taxation, they'll pay 15% of this, which is $9,000 by June 15, and cumulatively scale that up to the full $60,000 by March 15th. Section 5. Compliance and transition. Navigating the shift. Okay, understanding the theory is great, but compliance is where the rubber meets the road. The Income Tax Rules 2026 introduced some updated forms you absolutely need to know,
If an assessing officer sees a discrepancy based on your past assessments, they can actually issue a demand via Form 151 under Section 407. If that lands on your desk, you've got a choice. Either comply and pay it, or if you genuinely estimate your current income will be lower, file an intimation using Form 152 to address the estimate. And don't worry, Section 410 guarantees that any advance tax you pay gets fully credited to your account during your regular assessment.
Now, red alert for all the accountants out there. According to the official guidance, there is a critical trap during the portal transition. For tax payments relating to the financial year 2025-26, you still select assessment year 26-27 on the e-filing portal under the old Act. But for advance tax paid for the financial year 26-27, you must select tax year 26-27 governed by the new Act. Selecting the wrong year on that challan is practically a guarantee for massive reconciliation headaches down the line. And what happens if you mess up the installments? Well, it's going to cost you. A super common mistake is underestimating the September and December payments. If your total advance tax paid is less than 90% of your assessed tax, boom, that triggers a mandatory 1% monthly interest under Section 424. Same goes for deferring your quarterly installments. That attracts interest under Section 425. If you're a veteran pro, you'll recognize these as the direct replacements for the old Sections 234B and 234C. The section numbers changed, but the sting of the interest rates is exactly the same.
Section 6. Summary and Takeaways. Let's wrap up this explainer with the absolute key points you need to take back to your practice.
From the much-needed tax year concept to the brilliant A equals B minus C formula, the Income Tax Act 2025 simplifies the jargon but keeps the compliance incredibly strict. The 10,000 rupee threshold is still there, the 4 installments are still there, and the penalties for deferment are absolutely still there. You've got to be hypervigilant during this transition period to make sure the correct tax year is selected on the e-filing portal. That is your best defense against taking an unexpected hit under Sections 424 and 425.
As we move into this new era of the unified tax year, I'll leave you with this. Is your practice's software and team training fully prepared to prevent those costly portal errors on day one? Think about it. Now for the legal bit. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video. Thank you for watching. Please like, subscribe, and share. See you next time.